Have you ever watched a YouTube video about investing and at the end thought, that seemed like great information, but it was a little overwhelming? It'd probably be better if I knew what the heck all these acronyms and abbreviations meant. If so, you're in the right place. I'm Jonathan, and today I'm going to switch gears just a little bit from our normal video topics and get back to the basics. I've been considering making this video since I started my channel, and honestly, I just got wrapped up in providing you guys with the best information on specific dividend stocks and ETFs that I could. But the reality is there are a lot of new investors out there, and there's nothing worse than making an investment without truly knowing what you're really investing in and why. I was reminded of that last week when I received this comment from subscriber Eric Larkins. Hey Jonathan, I'm fairly new to investing other than an employer 401k. Do you have any videos about all of the numbers such as PE ratio and other ratios that are used to value a stock? And then I was brought back to why I made this channel in the first place. To educate and empower people to make decisions that positively affect their financial future. So yes, you'll continue to see videos on great dividend stocks and ETFs, but I'll also make sure to sprinkle in some investing education as well, and it starts right now. What we're going to do today is go through a stock chart from start to finish, explaining each metric in detail and why that information is important to an investor. We'll look at a few different sites that I use to get varying levels of information from. So let's cut to the chase. I'm going to use Yahoo Finance for the first look as it's well known and pretty commonly used. In my opinion, it's a great starting point. I'm also going to use Verizon throughout this video. There's nothing special about that. I just had to pay my cell phone bill this morning, so it was an obvious choice and already in the back of my mind. The first thing we'll see, of course, is the stock price and the price change for today if the market was or is open. It'll update in real time throughout the day. You'll get the previous close and open prices, which is simply the value of the stock when trading stopped on the previous day and what it opened at on the current trading day. Even though the markets are closed after 4 p.m. Eastern on trading days, stock prices can still move during that time based on recent news or market sentiment. We'll skip the bid and ask price for now and may cover that in a more intermediate video, as most new investors simply buy at market price. Next, you can see the day and 52-week range, which just highlights the low and high prices of the stock in that given time period. Now is where we start to get into the more immediately valuable data, volume and average volume. A stock's volume is a reflection of how many shares were moved during a given day. The main reason that this is so important is that a stock with a high volume means you can easily sell it at any time. A stock that has an extremely low volume means it may be more difficult to sell when the time comes. If you bought a stock that increased from, let's say, $1 up to $100 per share overnight, it wouldn't mean much if you couldn't move it. This is more important for day traders, and here we invest for dividends, meaning we hold them long term, but it is still something to pay attention to. It's recommended that most day traders stay away from stocks with less than 1 million volume on a daily basis. But if you're investing in good, quality companies with a track record of performance, this shouldn't be an issue. And as you can see here, Verizon has an average daily volume of over 20 million shares, well above the number we discussed. Up at the top of the next column, you'll find the market cap. Market cap, or market capitalization, is the total value of the company based on share price. Market cap measures what a company is worth on the open market, as well as the market's perception of its future prospects, because it reflects what investors are willing to pay for its stock. If you've been following stocks through either articles or videos, I'm sure you've heard the terms small cap, mid cap, and large cap. So let's dig into those terms just a little bit. Small cap companies are those with a market value of $300 million to $2 billion. Generally, these are young companies that serve niche markets or emerging industries and are considered the most aggressive and risky of the three categories. Mid-cap companies are businesses with a market value between $2 billion and $10 billion. Typically, these are established companies in industries experiencing or expected to experience rapid growth. They may be in the process of increasing market share and improving overall competitiveness. And finally, we have large cap companies. These are typically firms with a market value of $10 billion or more. Large cap firms often have a reputation for producing quality goods and services, a history of consistent dividend payments, and steady growth. They're usually dominant players within established industries, and their brand names may be familiar to a national consumer audience. They're generally considered the safest of the three categories. Next, we see beta. This is another more intermediate term, so we won't go into a lot of detail, but I'll touch on it just a little bit. Beta is a way of measuring a stock's volatility compared with the overall market volatility. The market as a whole always has a beta of 1. Stocks with a value greater than 1 are more volatile than the market, which means they'll generally go up more than the market goes up and go down more than the market goes down. Stocks with a beta of less than 1 have a smoother ride as their moves are more muted than the market overall. And then right below beta, you can find the PE ratio. PE ratio stands for price to earnings ratio, and what that tells us as an investor are the total earnings of the company divided by the share price at any given time. If you look, you'll see TTM in parentheses. TTM is an acronym for trailing 12 months, and what that means is the time period being reviewed is the previous year only. Some stock websites use FWD instead of TTM, and that means they're taking the estimated forward earnings of the company for the next quarter or the next year instead of the last year for their evaluation. So make sure you're paying close attention to that when you're reviewing a stock. The reason that the price to earnings ratio is important is that it can be an indicator of whether or not the stock is over or undervalued. Keep in mind that no single indicator is perfect and will guide you down the correct path, or everyone in the market would always win, but it is another piece of data to analyze. Price to earning ratios vary by company, industry, and sector, so PE ratio alone doesn't tell us a lot. What's more valuable to look at is the PE ratio of a company now compared to where it's been historically. I use Morningstar's website for that. You can find it in several places, but it's a really easily read format there. So let's switch over there and take a quick look. While we're doing that, if you're getting any value out of today's video, drop down and pop that like button so we can reach more people. And if there's something you'd like to see a video on in the future, drop a comment below and let me know. I read and respond to each comment as quickly as I can. Now, once you're at the stock page on Morningstar's website, just click on the Valuation tab and you'll see some important historical data. Under Price to Earnings, you can see the PE values over the last several years. For Verizon, it's lower on average than it has been historically, signaling that it could be a safe investment provided there are no other major factors. Now, switching back to Yahoo Finance, we can see the next metric is EPS, or earnings per share. Earnings per share is a figure describing a public company's profit per outstanding share of stock, calculated on a quarterly or annual basis. The EPS calculation is done by taking a company's quarterly or annual net income and dividing it by the number of shares of stock outstanding. Earnings per share is one of the most important variables for determining a company's share prices. A high EPS indicates that the company is more profitable and has more profits to distribute to its shareholders. This can also be easily viewed from a historical perspective on the Morningstar site, so let's jump back over there quickly. If you look under price to cash flow, you can see the historical values. Verizon's EPS is trending lower than its 5-year average, signaling that it's not increasing its cash flow relative to its stock price right now. Again, this isn't a metric to take alone, but it is another important data point. Let's go back to Yahoo Finance and look at the final items on the stock chart. The next two metrics are related to dividends, and as you know, that is the main focus of this channel. You can see the forward dividend and yield and the ex-dividend date. But we'll come right back to those as I like to use a different site for dividend information. The last item here in the Yahoo Finance stock chart is the 1-year estimate, which is simply the analyst's estimation of where the stock price will be in 1 year. My advice? Ignore this completely. Do your own research. If anything, you can compare it to the current stock price, and if it looks interesting, you can investigate further on your own. Now, on to the dividends. Let's jump over to another site I use quite a bit, Seeking Alpha. And before we move on to the dividends, if you remember earlier, I was talking about TTM or trailing 12 months versus FWD or forward earlier. You can see an example of that with EPS, earnings per share, or PE price to earnings ratio here. Like I said before, it's just something to pay attention to and both can be useful. So let's move over to the dividends tab. Seeking Alpha gives some very good detail here that's easy to navigate through, and that's why I like it for dividend review. We won't go through every single item, but I do want to discuss the critical metrics and data you need to keep an eye on. First, under the Summary tab, if you scroll down, you can see basic information. We'll go through these one by one. Forward dividend yield is the dividend you would earn on an investment over the next year, provided it doesn't change. Keep in mind that this yield is based on the share price at the time you buy it and changes as the share price fluctuates. To give a quick example, if you bought a share at $100 and it has a 5% dividend yield, you would earn $5 each year for that stock. It doesn't matter if the share price goes up or if the share price goes down. You would receive the $5 dividend until they make an announcement to change it. Next is annual payout. This is the amount you would receive per share over the course of a year if you were to buy and hold it over that time period. The dividend payout ratio is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. It's basically the percentage of earnings paid to shareholders through dividends. The amount that's not paid to shareholders is retained by the company to pay off debt or to reinvest in core operations. Next is a dividend growth rate, which is the percentage that the company has increased its dividend payout each year. This is also sometimes called the dividend CAGR, or compound annual growth rate. For an example, if you bought a stock that paid a $1 dividend per year, and next year they increase that payout to $1.25, your growth rate would be 25%. It's not a hard and fast rule, but right now I generally look for dividend stocks that have an average 5% or higher dividend growth rate over a period of at least 5 years. Dividend growth shows how many consecutive years a company has increased their dividend. This is important because it's a general indication that the company is growing and sharing that growth with its investors. With the next section, the important items are ex-dividend date, which shows you the date you must own the stock to receive the next dividend payment. The payout date, which is pretty self-explanatory, it's the date they give you your money, and the declared date, which is the date that they announce the next dividend. And last, we have the dividend frequency. Most dividend stocks and ETFs pay quarterly, but there are some exceptions to the rule. Some pay monthly or twice a year or even annually, and then there are select few that pay special one-time dividends based on company profits. There's several other tabs showing more detail for dividend yield, safety, history, and other data, and we won't get into that now. That's for another video, but I encourage you to take a look at the different information available when you have time. It really is invaluable. Just like I wouldn't give my money to someone I don't know to hold on to, especially if I don't understand their history of handling money, the same holds true with what companies I choose to trust my money with. I really hope this video was helpful to you as you begin investing, and if so, pop that like button and subscribe. I really appreciate you hanging out with me until the end. Thanks, and see you next time.